Every day, businesses make decisions that affect their cash, customers, expenses, and overall financial success. Accountants help track those activities by analyzing and recording business transactions in a structured way so that the company's financial information remains accurate and useful. In part one of analyzing business transactions with the accounting equation, we learned about Eli's consulting services and recorded the first 6 transactions of the business. These transactions included the owner investing cash into the business, purchasing equipment and supplies, renting office space, and hiring employees. Now, in part 2, we'll continue building on what we learned by analyzing 6 additional transactions that are common for many service businesses. We'll learn how to record revenue earned from customers, customer payments, business expenses, and withdrawals made by the owner. By the end of this video, I hope you'll have a better understanding of how everyday business activities affect the accounting equation and the financial position of a company. Just as a reminder, at the end of the part 1 video, we moved from the simplified accounting equation to the expanded fundamental accounting equation that uses the same categories as the balance sheet we prepared. Assets equals liabilities plus owner's equity. And the only changes really are that we're now using the term assets instead of property. And we're splitting the financial interest category into liabilities, which are monies owed to third parties like suppliers and banks, and owner's equity, which are monies owed to the owner of the business. And this fundamental accounting equation, assets equals liabilities plus owner's equity, is what we'll be using for the next 6 transactions and the rest of this class. For the 7th transaction of this new business, Eli's Consulting earned a total of $36,000 in revenue from clients who paid cash for accounting and bookkeeping services. So first, let's describe the financial event. And there are 2 things that happened here. First, the cash increased because the customers paid with cash or checks and the money was deposited into the business's bank account. So cash increased by $36,000 and cash is an asset. Second, the business now has more revenue of $36,000. Revenue is part of owner's equity because the profits of the business belong to the owner. So cash and asset account increased and revenue and owner's equity account also increased by $36,000. For step 2 of our process, we want to make sure that the accounting equation is still in balance. That is why we record the increase in cash in our accounting equation by writing plus $36,000 into the cash column because we just determined that cash increased. And for part 2 of this transaction, we add another category within the owner's equity section for revenue, and we'll write plus $36,000 revenue into that column. Let's double check that our accounting equation still balances once we sum up each column. Cash $119,000 plus equipment $11,000, prepaid expenses $8,000, supplies $1,500 for total assets of $139,500. On the right side of the accounting equation, we have liabilities of $3,500, trade in Eli capital $100,000, and revenue $36,000, which comes to $139,500. And that confirms that our accounting equation is still in balance because both sides of the equation show $139,500. In the 8th business transaction, Eli's Consulting earned $11,000 of revenue from charge account customers. That means that these clients are allowed extra time to pay the invoice. Accountants call monies owed by customers accounts receivable, and we're now ready to describe the financial event. For one, customers now owe Eli's Consulting $11,000. So accounts receivable and asset account increased by $11,000. And for the second part of the transaction, because remember, every accounting transaction has at least two parts, revenue and owner's equity account increased as well. We'll enter this transaction into the accounting equation by writing plus $11,000 into the accounts receivable column, and we'll write plus $11,000 into the revenue column as well. After we sum each column, we can see that both sides of the equation total to $150,500, and we still balance. When customers owe a business money, they will eventually pay, and hopefully sooner than later. In the ninth transaction, we record the customer payment when Eli's Consulting received $6,000 on account from clients who owed money for services previously billed. The customer gave Eli's Consulting cash, and Trayton deposited the money so that the bank account now shows more cash. So cash and asset account increased by $6,000. At the same time, the amount customers owe Eli's Consulting decreased. That means accounts receivable, also an asset account, decreased. We write this transaction into our accounting equation to check that our equation still balances by writing plus $6,000 into the cash column and writing minus $6,000 into the accounts receivable column. And as we've done before, we calculate the new totals for each column and double check that the two sides of our equation still balance. Here we have $150,500 on the left side and $150,500 on the right side, and that means that we're still in balance. For the 10th transaction, we're going to analyze the situation when Eli's Consulting paid the salaries for the accounting clerk and Sergio Sanchez. In this transaction, the expenses of the business increased, specifically salaries expenses, which are part of owner's equity, and the cash and asset account decreased because Eli's Consulting issued checks to the accounting clerk and Sergio. To keep things organized for Eli's Consulting, we'll add a new category called expenses to the accounting equation's right side, part of owner's equity. Let's write minus $8,000 into that column. Why minus $8,000 when expenses increased? That is a little tricky. Remember when I said that the profits of the business belong to the owner? And profit is calculated by subtracting the expenses from the business's revenue. Next, let's record that cash decreased as well by writing minus $8,000 into the cash column. When we sum up our columns and then compare the right with the left side, we can see that both sides of the equation still balance. $142,500 on the left side and $142,500 on the right side. We are in balance and ready to move on to the next transaction. The 11th transaction is very similar to the prior one. Eli's Consulting issued a check for $650 to pay the utility expenses. So in this case, utilities expenses increased by $650 and cash decreased by $650. So let's write minus $650 into the cash column and minus $650 into the expense column. Let's add up our columns and sum each side of the accounting equation. Our new totals are $141,850 on the left, as well as on the right side, and we're still in balance. Let's now look at our last transaction. On December 30th, Eli withdrew $5,000 in cash for personal expenses. Withdrawals are not a business expense, but a decrease in the owner's equity. Later, we will use a separate account called drawings. For this transactions, the drawings increased, which reduce owner's equity. Another way to think about it is to look at the drawings as a return of the monies the owners previously contributed. So owner's equity decreases by $5,000 because the business now owes less cash to the owner, and cash and asset account decreased as well. We record the two parts of this transaction by first writing minus $5,000 into the cash column because the business now has less cash. Next, for part two, we write minus $5,000 into the capital column because Trade and Eli now has less money invested in the business. We total the columns on both sides, and we can see that we have cash of $111,350, accounts receivable $5,000, equipment $11,000, prepaid expenses $8,000, supplies $1,500, for a total of $136,850 on the left side of the accounting equation. On the right side, we have liabilities of $3,500, capital $95,000 plus revenue $47,000 minus expenses $86,50 for a total of $136,850. We can see that we're still in balance because both sides of the equation show the amount of $136,850. And here's the fundamental accounting equation table for our 12 transactions for Eli's consulting services. And we can quickly see what transactions happened throughout the month. So what can we do with this information? Well, we can summarize it by preparing financial statements so that owners, managers, and investors can look at the information and understand how profitable and how financially stable the business is. Financial statements are reports that summarize the financial activities and position of a business. Said differently, they report the revenue and expenses, as well as what the business owns, what it owes to third parties, and what it owes to the owner of the business. Businesses typically prepare at least an income statement, a balance sheet, and a statement of owner's equity. However, it is common to also prepare a statement of cash flows, which shows the financial statement users the cash inflows and outflows of the business. Preparing financial statements is an important job of accountants. For one, many business decisions are made based on the information in financial statements. In addition, investors rely on the financial statements of private and publicly traded companies, and banks make loan decisions based on financial statements. Now, this is very important. We first prepare the income statement, then the statement of owner's equity, and finally the balance sheet. The income statement shows the results of the operations from the business for a specified period of time, such as a month, a quarter, or a year. There are some exceptions, but those are the typical time periods for financial statements. The income statement shows the revenue earned and the expenses of doing business. Companies often report their revenue and expenses for a calendar year, but some companies choose a different fiscal year, like for instance from July 1st to June 30th. The income statement is sometimes called a profit and loss statement, or P&L for short, or a statement of income and expenses. The income statement starts with a header section where we list the name of the business, the name of the financial statement, and the time period on the third line. In the body of the income statement for Eli's Consulting, we list the revenue of $47,000 and expenses of $8,650 and calculate the net income or profit of $38,350 by subtracting the expenses from the revenue. Now that we know the net income or profit of the business, we can prepare the statement of owner's equity. That's right. You can't prepare the statement of owner's equity until you finish the income statement. We complete the header section of the statement of owner's equity by writing the name of the business, the name of the financial statement, and the time period on the third line. The statement of owner's equity reports the changes that occurred in the owner's financial interest during the reporting period. In the body of the statement, we start with the beginning capital balance of $100,000, which Trade and Eli contributed to the business in November. The profit of the business belongs to the owner of the business, and we list that on the next line, but subtract any money the owner took out of the business as drawings. We tally up the net income minus the drawings and write that amount of $33,350 as an increase in capital on the next line. We then add that amount of $33,350 to the $100,000 capital and calculate the ending capital for Trade and Eli as of December 31st of $133,350. Next up is the balance sheet. Why is the balance sheet last? Well, because we need the ending capital balance from the statement of owner's equity to complete the balance sheet. The balance sheet reports a business's financial condition as of a certain date, like for instance here for Eli's Consulting Services as of December 31st. The balance sheet shows what the company owns, what it owes to third parties, or the owner of the business. In short, the assets, liabilities, and owner's equity of the business. Eli's Consulting lists its assets of cash, $111,350, accounts receivable, $5,000, supplies, $1,500, prepaid rent, $8,000, and equipment of $11,000 for a total of $136,850 in assets. On the right side of the balance sheet, Eli's Consulting shows the liabilities for accounts payable of $3,500, the owner's equity of $133,350 for a total of $136,850. And we're still in balance. What we have here is a relatively simple set of financials. It only includes 12 transactions, and the financial statement of most companies, even small ones, have hundreds or thousands of transactions. However, they follow the same concepts and process. Chapter 2 of our textbook, College Accounting, introduced some of the most important building blocks of accounting, including assets, liabilities, owner's equity, and the accounting equation. You learned that every business transaction affects the accounting records in at least two ways, which helps keep the accounting equation in balance. We also explored how accountants analyze business events before recording them to determine whether they should be included in the accounting system. Using the accounting equation as a guide allows accountants to better understand how each transaction impacts a business's financial position. These concepts form the foundation of accounting and will continue to appear throughout the course. And as we move forward, we will build on these ideas by introducing another important accounting tool, the T account, which helps accountants organize and track changes in individual accounts in greater detail.